Gold, a race to the bottom. This is the Equity Management Academy weekly podcast for May 11th, 2022. Summary. The Consumer Price Index inflation rate slowed at 8.3%. The 10-year note is at 3.01%, moving back above 3%. We appear to be building a bottom in gold, silver, the NASDAQ, and S&P. One thing that the mainstream media appears to be missing is the closure of the Black Sea ports, which cuts Ukraine off from the world, and Ukraine is a breadbasket for the world. Fundamentals. The Consumer Price Index inflation rate slowed at 8.3%, but inflation is still at high levels, and it has risen over the short period of time. The 10-year note is at 3.01, moving back above 3%. We may have reached a strong resistance level for the 10-year note at 3.13. The ceiling seems to be at about 3.25% yield. This is causing a reversal in the market, with the NASDAQ and the S&P potentially moving up. The 10-year trading at 3% puts the Dow Jones at about 4,100 as fair value. So trading around 4,000 makes it somewhat undervalued in terms of both the NASDAQ and the S&P. The variable changing price momentum indicator appears to be indicating that we are looking at a bottom unfolding in stocks. NASDAQ is building a bullish price momentum within the bigger downtrend. The floor appears to be around 12,015. It could gain momentum up to 12,600 or even up to 13,092. There is resistance around 12,550 to 12,700, which needs to be broken. The odds appear to be that the NASDAQ will move up with more short covering. We appear to be building a bottom in gold, silver, the NASDAQ, and the S&P. If the 10-year note goes below 2.75% yield, it would confirm that the inflation numbers have peaked and interest rates have also peaked, which would be bullish for commodities and stocks. More supply chain disruptions. One thing that the mainstream media appears to be missing is the closure of the Black Sea ports, which cuts Ukraine off the world, and Ukraine is a breadbasket for the world. Russia is bombing silos and fields in Ukraine, which reduces grain and other agricultural exports from Ukraine. Sanctions are also keeping Russian agricultural products out of the global market. Poorer nations, especially in Africa and the Middle East, are dependent on such exports to keep food prices down. We are in the midst of not only a war in Ukraine, but an economic war between Russia and the West, with China dealing with its COVID lockdowns. The supply situation appears to be destined to get worse, which will raise food prices even more. Western sanctions against Russia appears to be contributing to increasing inflation. The balance is between the economy and the war, with Russia seeking to control the oil and gas in the Black Sea region, which is a major producer. In terms of rates, the Feds face the risk of raising rates too fast, too soon. But the market already has moved the 10-year note about 3%, while the Fed talks about tapering and raising interest rates. The market, in a sense, is doing the Fed's job. Price direction and standard deviation. Silver. Silver is at $25.85. We recommended long silver at the weekly buy 2 level of 21.37 and the buy 1 level of 21.87. We have a conflicted picture. The weekly numbers for silver indicate that we have a lot of support in that area. This is where you want to accumulate supply or inventories if the market gives us a short signal short term. We are at an extreme below the mean, where the odds greatly favor the market reverting back up. We are probably going to get more short covering in silver. We are trading above the weekly level of 21.87. This is now a support area. The daily market momentum is bullish and the weekly target is 22.61 according to the AI of the variable changing price momentum indicator. Yesterday, we seemed to put in the low for this movement at 21.15. We have buyers coming into the market and the market may be changing to a bullish trigger point with 22.61 as the weekly target. Gold. Gold came back up above the weekly buy 2 level of 1821. 1851 is the weekly buy 1 level with a daily target of 1856, which was completed. Now we are back testing the 1851 level. We appear to be building a bullish price momentum. We hit 1856, so now a close above 1846 will activate another daily bullish trend momentum. If we break down, we could reach 1827, which is the daily buy 1 level. However, the weekly numbers are in a major area of support where you should accumulate long positions. We are buying the dips in gold to add to our long-term position in gold. Equity Management Academy CEO Patrick MontesDeOca said.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, EMA2trade.com, or listen to any of our previous episodes.
Testing 1 2. I'm having a little bit of sound problems here. I'm just getting some readings here. Can you hear me? Testing 1 2. Okay, we're back. I apologize for that. As we are taking a look at the markets here, that essentially, as I was saying, has gone into some kind of a fear mode. And let's focus here on what the technicals of the market seem to be indicating for us as we see where we are with relation to the variable changing price momentum indicator. Looking at the standard deviation numbers here, we're looking at the NASDAQ on the board, and we are reverting from the buy one level of 11,783 as we come in today. And this is what basically the algorithm is identifying for us, that this pivot level here is confirmation of a reversion unfolding to the upside. This is what we call a buy trigger. And you can use this information to day trade the market, to identify relationships between the daily patterns, the weekly patterns, and the monthly patterns. On the left of the chart, we have the weekly pattern as we are coming into this week, which indicates the buy two level to be at 12,310. This is the two standard deviation for the weekly numbers. And what you can see here is that the market is extremely oversold. It's below that extreme below level weekly, and it has come down even below the daily standard deviation of 12,168. As the signal was activated at 8:30 a.m. yesterday morning, the target basically was the 11,783 level, or basically the buy two level that we see here, which is the 11,553. These are levels that the standard deviation is telling us potentially the market, if it reaches these levels, it's going to be extremely oversold. The color in blue here that you see basically identifies a mathematical probability of about 90%. And as traders, we can only, as far as I'm concerned, use the best tools that we have. Nothing is a guarantee in these markets because the fundamentals can completely turn upside down the markets like it is right now. And it sets a level of panic and fear in the marketplace that you can taste it in the air. And obviously, if you're running longs, or if you have a large portfolio, or if you Cathy Wood, you're down 70% and everybody thinks you're an idiot, including yourself. And this is when the time comes for self-doubt and control in terms of decisions that you want to make, which are sound decisions based on not emotion, but based on the highest probability levels that we can find. And that's using mathematics. That's using standard deviation. That's identifying the extremes of the market above or below. And that's exactly what this code is doing. I am carrying, and I have been recommending here in my trading room for my subscribers and my long-term traders to take a look at basically what's going on in the real world. Russia, Ukraine, the Eurozone. This situation has turned the markets completely upside down, and it has basically shifted the, you might say, dynamics of the markets completely upside down, as we are seeing with interest rates. And again, one of the key things that I am watching very closely is the cost of money. And for that, basically, I take a look at the 10-year note. Which is the intermediate to short-term end of the yield curve, as the 30-year bond basically is the long end of the yield curve. And that's primarily where most of the money is located. But what I want to point out to you here is that the panic that we see in the market is of higher interest rates, because that's what the media is posting all the time. The media is behind the curve, just like the Feds. Rates already went up yesterday to a high of 3.3%, I believe, and that's the market dictating the rate that it should be based upon the risks that we are running with inflation, with the debt levels that we have, which are historic on a global basis, basically. And so the likelihood of interest rates rising any further is diminishing, according to the 10-year note. The peak was yesterday at 3.13, and this is what I posted on the Associated Press. We're back down to 285. We have broken this uptrend in interest rates since March, just from 169, or let's say into the 150 levels that we saw. We have doubled the cost of money. And I think for most people, they don't grasp this yet. It takes a few months for this to filter into the economy, to affect your credit, your interest, the pressure of interest rates going up on your loans, and mortgages have more than doubled since March. This is not a sustainable path. And anybody that got caught in using this free money in the last couple of years basically are underwater. It obviously relates to real estate. It obviously relates to all these highly leveraged instruments. And the worst thing basically that happened is, according to some inside sources here, that we're going to begin to see a great deal of credit default from people that have used this free money, credit cards, to buy Bitcoin, to buy the market, to go to stocks. That's been the process, unfortunately, for naive investors that got caught into the euphoria of this speculation that we've seen here in the last couple of years as a consequence of this free money. Not understanding leverage is probably the worst thing that any trader can do. Understand leverage. And this is what we're trading here. We're trading, the futures contracts that are highly leveraged, and we use a small percentage of the full size value of the contract, but the liability is the full value when you trade it. Most of these contracts were designed primarily for hedgers, farmers, back in the early days. But it became a tool where speculators can come in and trade the market and use these tools. The problem that we have right now that I see, and it's affected my perspective and point of view, is that there is so much false data out there, and you really don't know where to go. You really, don't know what's real and what's not. So you got to take the responsibility and really dissect for yourself and get to the bottom line. And to me, there's nothing more than the bottom line to let the market tell me potentially what it's doing. Follow the money. And where is the money? The money is in the 10-year note. And rates on the 10-year note are coming down because there is so much money going in there. And that is going to force rates down, not up. And that's going to alleviate some of this panic set in because of this inflationary levels that we're getting, which is really after the fact. The market came down in anticipation of this inflationary levels. It already discounted this. And so we've come down to obviously some major levels of support, but the VCPMI, which is the indicator that we use, is indicating that we, again, are in an area where we can potentially see a reversion to the upside unfold. This is using purely artificial intelligence. The area in blue here that you see is a very high mathematical probability to accumulate supply, inventory. And although it doesn't pick a bottom, and only the market will do that, when the price reaches this level and reverts into a green candle, that means that buyers down here are a lot stronger than the selling supply that's occurring here. And pretty soon we start getting prices above these levels and signals, triggers are being activated. So as the market is panicking, when you put on CNBC, when whatever source you have, it's all about inflation. It's all about record levels, 40-year levels of inflation, and the panic is prevalent out there. And that's the sentiment. Now, I'm going to talk to you as a trader that you got to measure that sentiment, because that sentiment is where the volume is. That sentiment is where the majority of the money is. The psychology is that prices are going to go down. Well, the indicator that we use is saying the opposite. It's a contrarian indicator. And it's given us a level where we expect a reversion to unfold, and of course the market will do the rest. And what you're seeing here is potentially the market confirming that. The low was 11,693.25, and the algorithm told us to start buying at 11,783. And if the market comes down to 11,553, you want to add to another position. And if you want protection, you can use the close below 11,553. Or the low that we made. today of 11,693. So here's how I identify the trade. It activated a daily buy trigger. It's long. The target, the first target is 12,168 that it gives us. Okay. Now, when you incorporate the weekly buy to level of 12,310, it means basically that if we engage the market into this price and closes above 12,310, that is a weekly buy trigger with 95% probability of a reversion occurring back up to 13,133, which has been the weekly 50-50 standard deviation level, or the mean, or the average, as most people say. And it's in green. It's in green for a reason, because it's a 50-50 standard deviation. And so we're beginning to see price trade into this level. Okay, and the question now is, are buyers stronger than sellers down here? That's what's going to determine the next move. And that's what's happening right now. That's the exchange of sellers and buyers at this level. But to activate the trigger point for you guys that are looking to identify entry points, this is what the NASDAQ is saying. So let's watch the NASDAQ here and let it do its thing. Let's go into the gold market here, and we're taking a look at gold pretty much in the same levels here, coming down below the average price and coming down into this levels of buy one level here of 1836. It almost we made a low here of 1835.10 just a bit ago, and this is activated. This is activating a buy trigger in gold. From the buy one level. Let's look at silver. Silver is pretty much doing the same thing. Already it reverted from the signal early this morning at 4:15 a.m. From 2090 to 2118, it completed the target and reverted back down, almost tested that level of support again. Now it reverted back up again. That means that there's a lot of trading going on in this price range, and that's exactly what should happen in this level when the price reaches this level. So what you can see here is pretty much the same pattern that we see here for silver, for gold, and pretty much for Bitcoin. That seems to be a very close relationship, which in some sense, to me, what it's telling me that obviously Bitcoin is being traded pretty much as a currency, as a digital currency. And even on Bitcoin, you can see the market coming down here into this buy to level, activating a buy trigger. So let me just reiterate this once again. I've gotten very much involved here with this identifying very, very microscopically, you might say, some of the signals here. So we definitely want to stay long the metals here. We want to stay long silver, and we want to stay long digital assets, and also we want to stay long on the NASDAQ from these levels. You can use a hard dollar stop if you want to protect yourself, but in the meantime, my friends, you're looking at the variable change in price momentum indicator, and although it's not a perfect science, it gives you pretty strong signals that you, as an individual, as a self-directed trader, can customize it for your personal portfolio. Have a great trading day, my friends, and we'll talk to you soon. Take care, be well, be safe.